Yesterday was more of an accounting and technical training. Today's a lot of the other good stuff, hot topics, regulatory, things that you guys are dealing with more day to day. We have some good presenters on the docket, and we look forward to what they have to say. Some instructions here on the audio controls, and if you have any technical questions, shoot us a message and we'll get you sorted out. In the meantime, we like to move forward with the show.
Great.
You have control now, Jeff, I believe? All right.
I do.
Our first speaker today, Jeff Cardone. Jeff is a partner at Luce Gorman, and Jeff is, I think this is probably his third or fourth year presenting for us, and always has good topics that are engaging and enlightening. So, Jeff, take it away.
I appreciate it. Welcome, everyone. It's a pleasure to be here. As Mark noted, my name is Jeff Cardone, and for those who don't know me, and partner at Luce Gorman, and just to give a brief background on Luce Gorman, for those who are not familiar with our law firm, we are a law firm that focuses almost exclusively on the community bank industry, and we primarily focus on corporate, regulatory, comp and benefits matters, really with an emphasis on transactions, and M&A, the capital markets, sub-debt, and so forth. We got 21 attorneys, and we represent about 300 financial institutions, including about 40 community banks in the state of New York alone. So it's a great pleasure to be here. We work in lockstep with Bonadeo, and you're right, Mark, I think this is my fourth year presenting for the conference. Excuse me. As far as the agenda today, the overall theme is going to obviously be focusing more on capital planning, both from a strategic plan standpoint and trends, things that we've been seeing with our client base, things that I've been talking about to boards, particularly, during COVID. And then we'll touch on a little bit about use of capital, growth strategies, sort of things we've been seeing, from an M&A standpoint, more measured transactions, whether it's branch transactions, fee-based businesses, et cetera. And we'll then touch on a little bit on some defensive strategies as well from a capital management standpoint. I always like to kick off when talking about trends just to give a little bit of a regulatory update. Things have been going on from what we've seen. If you sort of take a step back, from the financial crisis in 2008, obviously the banking industry was under intense pressure from the regulators and so forth. And we started to see, really when you had, the Trump administration take over back in 2016, you started to see a bit of softening from the regulatory standpoint. And you saw that, tangibly with, the Regulatory Relief Act, which had some modest rollbacks of Dodd-Frank. I wouldn't say there was anything real game changer in talking with, our community clients. Some of the stuff we'll talk about from a capital perspective. But I think probably more important from what we saw from a regulatory standpoint is really just sort of a change in tone from the regulatory agencies, sort of moving away from that gotcha mentality, sort of the regulators trying to work with you to get things done. We certainly saw that in the M&A context, in the regulatory approval process, certainly a more streamlined process for getting deals done, even during COVID. And and I don't want to say that was really Trump specific. I think it was really just the fact that, as 2016 and beyond, we were much further removed from the financial crisis. So there wasn't sort of this, oh my goodness, the sky is falling. Banks were healthy, well capitalized, and so forth. And so that was sort of helpful from a regulatory standpoint. Then obviously we had COVID, and banks are, as of right now, they're building up their allowances, given the uncertainty about asset quality. A big thing impacting the industry. Certainly, bank stock prices are depressed. A lot of banks, their stock prices trading below book value or tangible book value, although the market seems to be doing a little bit better. You're also seeing a little bit of core earnings flattening due to, margin compression and increased provisioning. And I would say this is out of the big issue when I talk to boards that's keeping them up on that, I would say really is the core earnings piece. While, there's a lot of focus on asset quality with COVID, if you have example exposures to COVID-related businesses, like the hospitality industry, et cetera. really the interest rate risk, being so low, and that's going to be prolonged. I mean, it's really putting pressure on banks just from an earnings perspective. And then adding to the uncertainty is, we're going to have an administration change. And so that's creating certain questions from a regulatory perspective. And, it's going to be interesting to see with the Biden administration, how sort of their new policies is how that's going to impact the community banks. I think a few things we've sort of highlighted here. I mean, certainly you're going to see the regulators, there's going to be a greater emphasis on dealing with racial, gender, income inequality issues. I know for public companies, and we represent about 70 publicly traded companies of the community banks, those listed on NASDAQ. I mean, NASDAQ already put out proposed listing rules where you have to have at least two underrepresented groups on boards, and so forth. So, I mean, that's creating certainly quite a stir. You may see sort of a greater emphasis on consumer protection. And the thing I highlighted here too with capital, it's possible we're going to see more stringent capital requirements, particularly when, hopefully we're sort of entering we're past the 50-yard line with COVID and with the vaccine. But until the regulators get a full understanding of the fallout, I mean, that could kind of impact from a capital perspective. For example, I know the community bank leverage ratio for those institutions that elect to do that, the regulators had discretion to set it between 8 and 10%. Prior to COVID, it was 9%, excuse me, and now it's down to 8%. And I know there's a big push to make that permanent. I'm not sure that's going to happen, depending on President-elect Biden, who he appoints at the regulatory agencies, remains to be seen. I would also anticipate, for larger deals, they're going to get more scrutinized. For example, I know Elizabeth Warren had proposed getting the CFPB involved or requiring their approval as part of the regulatory process. I think certainly large transactions where you're seeing, a ton of, branch closings for cost saves, et cetera, are probably going to get scrutinized just from a CRA standpoint and the like. And then lastly, taxation of credit unions. I would say from the credit union's perspective, I know the community bank industry has been fighting this fight for many years. I think this will probably get a little bit more attention given the amount of debt we're accumulating and the fact that credit unions are now really, more behaving like banks. They're buying banks. There's a proposed rule on sub-debt to sort of level the playing field from a capital perspective. So there could be some political momentum, remains to be seen. In terms of capital planning, I kind of like to look at capital planning really from two viewpoints. You obviously have, from a risk management, safety and soundness perspective, sort of how the regulators are going to, there's certainly going to be, it always is, and it's certainly going to be enhanced with COVID. Your capital plan is going to get scrutinized by the regulators. And certainly big area of concerns from a safety and soundness standpoint is, enhanced provisioning due to COVID. We talked about this in the prior slide, low earnings and enhancing your core earnings, and so forth. And then from a strategic planning standpoint, obviously it's important you want to have sufficient capital and making sure it's aligned with your initiatives, whether it's from a growth perspective or a defensive standpoint perspective. One thing I always try to tell boards is in management, you really want to try to avoid just-in-time capital. You really want to limit deal contingencies because I can tell you, you may say, look, I'm interested in acquiring branches or I'm interested in an M&A transaction, et cetera, and you just never know when the right deal comes along, and obviously you want to be prepared to execute on that from a capital perspective. From a risk management perspective, I like to kind of look at it two ways. I mean, obviously, step one is you obviously want to sit down, as part of your enterprise risk management, so forth, is really just identifying, evaluating your risks. So you kind of look at your organization and what are our credit, operational, interest rate, compliance risk, and how's that going to impact our overall capital adequacy. Great examples that, I know the regulators focus on for institutions that, have high concentrations of CRE. You've implemented, growth plans without, really appropriate changes to staffing. You're entering to new lines of business. again, the impact of COVID, sort of looking at your organization. This isn't really a one-size-fits-all, and what's our exposures, what are our risks? And then obviously, step 2 to that is, okay, how do we align those risks with our capital plan from a capital adequacy standpoint? And certainly when you're thinking about capital, I think a great starting point is, what's feasible and what's a feasible source of capital for our institution. For example, I work with a lot of, closely held community banks, and, issuing new common stock is really off the table because their existing shareholder base does not want to be diluted. So really, if they're going to tap into the capital markets, it's sub-debt is going to be really the way to go. You can also think about defensive capital raising measures. And we'll touch on this later on in the presentation. For example, a lot of institutions are selling branches, to sort of enhance their efficiency ratios, reduce costs. I'm working with a client right now that's in the process of selling its insurance business, again, just to cut costs and sort of a short-term capital raising transaction. The other thing to keep in mind when you're looking from a risk management, your capital adequacy, you want to look at, really from a stress test, worst case scenario standpoint, how are adverse changes to the economy, to the interest rate environment, how's that going to impact our institution, from a capital perspective? I mean, certainly that's an area the regulators are going to be focused on. And obviously, regulators will expect, while you have your minimum capital requirements, they're going to expect that you're going to have, higher capital levels, particularly, as your business change or you're engaged in quote-unquote riskier behavior. And lastly, when from a risk management standpoint, board oversight is paramount. I mean, the board should be involved, should be at a minimum annually reviewing your capital plan. You should it's great practice to document your risk tolerances, making sure that it's communicated throughout your organization. Those seem to have the most effect in terms of a successful capital plan from a safety and soundness standpoint. As far as aligning the capital plan with the strategic plan, kind of moving on from purely risk management, obviously when you're thinking about capital, sitting down, okay, from an offensive standpoint, what are we thinking about in terms of growth, whether we want to grow organically or by acquisition, whether it's whole bank acquisition or more measured transactions. And that's one aspect of, offensive capital planning. Beyond just growth or being acquisitive, looking at, having more liquidity in your stock, which could benefit, have sort of a twofold effect. One, it can provide sort of a liquidity event for existing shareholders, and secondly, you're creating a currency that could be more attractive to the extent that your institution wants to do deals. And then thirdly, it's for some institutions, I had a client, for example, they did a very measured common stock private placement offering, and the goal behind that was just to add new shareholders beyond the boardroom. It's a very closely held institution, and so they were trying to spread out the ownership and get shares to key customers of the bank. And then as far as, defensive capital planning, obviously, having enough reserves to deal with any adverse, consequences, whether it's related to COVID or otherwise, or interest rate risks. Certainly, you can raise capital to recalibrate the balance sheet. A great example of that is we've had clients, issue subordinated debt, which I'll touch on later on in the presentation, and to sort of use that to sort of refinance, old sub debt or trust preferred securities, with higher yields and so forth. And then you could also, to prop up your stock price, we getting a lot of questions from boards about share repurchases. And something to keep in mind with the Fed, if you haven't done or undertaken any share repurchases, in this environment, while you can do it, it's certainly a more formalized, the Fed has made it a more formalized process, particularly the Federal Reserve Bank of New York. So if you're, where you just have, prior, you just sort of notify them that you were doing a buyback. Now, they may require some pro forma information, et cetera. Again, not that you can't do it, but there'll be more of a regulatory step to doing it, depending on your institution. And then other capital planning considerations, when you're sitting down and thinking about your capital plan, obviously you're going to want to know the goals of your constituents. What I mean by that is, looking at your shareholders, going back to my prior example, again, if you're common equity may not be in the cards if your institution doesn't want to dilute its existing shareholder base. Certainly board and management as well, thinking about some of the offensive or defensive capital strategies I touched on before. Obviously, you're going to want to know the sources of capital, and that should be sort of embedded in your capital plan. If you need to raise capital, where are you going to get it? You know, for a lot of institutions, it's just you look to your boardroom as sort of a starting point. But you may want to broaden that for various reasons, whether it's in the local community or getting institutional shareholders, you know, to get more liquidity in your stock and so forth. And then we're also very important from a capital perspective is if the why, like, or the what, excuse me. What do you want to use the capital for? Whether it's to grow, you know, do deals, you know, refinance, you know, existing debt instruments, and then and your strategic goal kind of will determine, you know, what's the appropriate capital raising, you know, matter you're going to want to undertake. And then lastly is the regulatory capital structure. What's most advantageous for you, you know, whether you're operating under the community bank leverage ratio or, you know, Basel III. And that's kind of a good segue with the regulatory environment for capital. So the community bank leverage ratio, this is one of the big changes from the Regulatory Relief Act. And essentially, the whole premise behind this is that if your institution is less than $10 billion in assets, you would have the ability to opt out of Basel III regulatory framework. And then the benefit to that would just be you don't have to get into the business of risk weighting and doing your call reports. It's just a much easier one calculation where you would just essentially, as long as your community bank leverage ratio, which is really defined as your Tier 1 capital relative to your total consolidated assets, if that ratio is greater, well, currently 8%, you can opt out of Basel III. Although that percentage was, as I said earlier, it was set at 9%. It dropped to 8% with the CARES Act, and it's supposed to revert back in 2022. And then the other benefit of the community bank leverage ratio is you're deemed well capitalized, assuming you meet the requirement from the prompt corrective action framework. I think the problem, you know, and interestingly, the FDIC put out a report about the community bank leverage ratio. You know, a lot of institutions are not really taking advantage of this as the sort of the policymakers had thought. I mean, I think the smaller banks was roughly about at the 15 to 20%, and for the larger institutions, you get approaching the 10 billion. That is less. I think the big issue with that and the reason why is the fact that it's only on not permanently, but it's 9%. I think if it was permanently at 8%, I think you see more institutions take advantage of that. And then the other problem is if you fall below the 9% or currently the 8%, there isn't a prompt corrective action framework within the community bank leverage ratio framework. So in other words, you'd have to then revert back to Basel III. And so for a lot of, you know, clients I'm working with, it's like, well, what's the point of doing that? So that's kind of been the big drawbacks to it. I guess we'll stop right there for the first poll.
I'm going to launch the first poll, everyone. Remember, if you're looking for CPE, you need to answer the polling questions. For the rest of you, I leave it up to your discretion. All right. Jeff, have they put out any stats on how many institutions have elected the leverage ratio?
Yeah. I could, if anybody's interested, I can circulate. The FDIC did a report earlier this year about it. Yeah, and I don't recall the exact numbers, but it wasn't a big number, and it was basically institutions less than 250 million were the ones more doing it than, as I said, the ones going closer to 10 billion.
All right. Give you another few seconds, then we're going to close the poll out. And it's closed. And I think you should all be able to see the results now.
want me to tell them the answer?
Yeah, it's always helpful.
The answer is 5,031, according to the FDIC. All right, so we touched on the community bank leverage ratio as part of the Regulatory Relief Act. I would say the most impactful change is under the Regulatory Relief Act from a capital perspective was the acts increasing the small bank holding company policy statement threshold to $3 billion, from $1 billion to $3 billion. I think Dodd-Frank had upped it from $500 million to $1 billion, and it's now up to $3 billion. And the significance of that is if your institution is less than $3 billion, you do not, and you have a holding company, your holding company itself does not have to satisfy the regulatory capital requirements. You solely have to satisfy them at the bank. And where this has significance and why you've been seeing a lot of subordinated debt deals is that institutions, because of this, who are less than $3 billion, is that they can leverage debt at the holding company, and the capital they raise at the holding company, they can downstream that to the bank, and at the bank, that downstream cash is Tier 1 capital, pure, but the debt at the holding company does not count against your institution as long as you're under $3 billion. If you're over $3 billion, then it would be impactful. So that is the big significance of this. And I think roughly about 90% of depository institutions are below $3 billion. So this was a real meaningful change, particularly if your institution, even if you were below $1 billion but sort of approaching that, this has been really impactful. And one of the things I'm going to touch on with in terms of prevalent source of capital right now with COVID has been subordinated debt. And we've been doing a substantial number of these transactions. And in terms of from a legal perspective, subordinated debt, it's a security. It's a debt security. But really, practically speaking, the way a lot of these deals structured, when you really get down to it, it's just a series of borrowings that the holding company is getting from investors. And those borrowings are structured in a way that they receive favorable regulatory capital treatment. I mean, that is in essence what subdebt is. Holding company is just borrowing money from, a pool of investors to raise the requisite capital that it needs as part of the transaction. And in terms of the way they're structured, now, again, if you're below $3 billion, you don't have to structure it in a way that's going to get Tier 2 capital treatment. But in terms of how these deals are structured, that's sort of been institutionalized. So just to kind of give a high-level summary of that, I mean, the subdebt, it's unsecured. And if it's, as long as you have a minimum period of at least 5 years with no callback rights, the term is typically 10 years, although we've done some deals where it's been 15 years. You have an interest rate generally that's fixed during the first 5 years, and then it converts to a floating rate. So as long as you're doing those things, that debt is going to get Tier 2 capital treatment. But again, if you're below $3 billion, it doesn't really matter because you're not satisfying, capital requirements of the holding company. If you're above $3 billion, then it's more meaningful. You're going to want the Tier 2 capital treatment because then at least the debt itself will help your regulatory capital ratios. A few things to keep in mind, during the last 5 years of the debt term, the Tier 2 capital treatment will decrease by 20% per year. You just got to be mindful of, particularly for below $3 billion, your debt to equity ratios. You don't want to go too crazy. So, for example, if your debt to equity ratio exceeds 1-to-1, you may be more limited in your ability to pay, dividends and repurchase shares. And then a big discussion point, when you start pricing and what the interest rates are going to be is, can you service the debt? Because unlike common equity, where you sort of arbitrarily decide if you're going to pay a dividend or not, remember it's a borrowing, so you're going to have to pay the interest on the debt, and if you don't, then you're going to be in default. The general process, as I talked about before, generally these deals, particularly institutions below $3 billion, they're for federal securities law standpoint, they're private placements, and they're issued to accredited investors. So actually, probably the biggest investors of the subdebt is other banks. But you'll see insurance companies and other asset managers as well. And as I said, they're individual borrowings. So from a legal perspective, if you had, for example, 15 investors that you were issuing debt to, you'd have 15 individual note purchase agreements and notes, even though they're all sort of uniform. But again, that's sort of the typical legal documents. You typically are going to have a placement agent or investment banker involved. I know the Piper Sandler folks will be talking about that. I mean, they're sort of the industry leader on that with sub debt. And again, they could be very helpful in terms of obtaining optimal pricing. Some of the characteristics that influence pricing, obviously, the asset size of your institution, your credit quality, your financial performance. And for a lot of institutions, you could get a bond rating. And that's really adds value if you're, for example, an investor is going to be like an insurance company. Some investors require that. If your primary investor is going to be other banks, getting a rating may be less importance. And again, the rating can help from a pricing perspective. I mean, generally, we see these deals range from about 4% to 6% in terms of interest rate. So you may be able to shave off 25 basis points, for example, if you're rated. And again, this is something you can talk to, the Piper Sandlers of the world about and whatnot. Poll question 2.
Just a reminder to everyone, please respond to the polls if you would like CPE. And if you have any questions, please try and send those to all panelists so that we are sure the speaker sees them. Great. Question 2. Oh, did I launch? Yeah, I launched the right one.
This question is, how many U.S. financial institution merger transactions were there currently in 2020?
We do have a question, Jeff.
Yep.
Interest on sub-debt is paid out of the holding company. How do you ensure that there is enough funds at the holding company to make these payments? What happens if the FDIC OCC limits transfers from the bank to the holding company?
Well, that's a great question. What a lot of institutions will do when sort of assessing how much capital, you're going to want to keep, some reserves at the holding company when you do it. And so really then typically companies, roughly about 2 years worth. It depends on how much capital you raise. But that is really important because, again, you can then easily pay down the debt. Because anytime you have to dividend money up from the bank to the holding company, it's a more cumbersome process. So you're going to want that would sort of factor in how much capital you're going to raise. Like, for example, if you were I need to finance something that's $10 million, you're probably going to want to raise more than $10 million because if you're going to, let's say, use 100% of the sub-debt proceeds for that. But that's typically how institutions do that. So at least they have enough powder at the holding company where if there was any issue, dividend up the money from the bank to the holding company, they would have the reserves to pay the interest or service the debt. Is typically how these are done.
All right. We have closed the poll. Which one is the correct answer?
107 according to S&P. So generally, we'll talk more, but generally it's been roughly 250 a year since the financial crisis. But yeah, this year, for obvious reasons, M&A has slowed a bit. So we're at currently 107 according to S&P. So it's kind of a good segue into growth strategies from a capital perspective. Again, not surprisingly, M&A is down. Obviously the uncertainty of COVID has caused that, but I also think an equal factor certainly is declining stock prices. So your traditional acquirers, they don't necessarily have the currency to do a transaction because it's going to be too dilutive, to their shareholder base. And I think that's been very impactful from an M&A perspective. Although the nice thing is bank stocks are sort of creeping up, which if that's the case, you'll sort of expect, more M&A activity down the road. I know we've been working with clients and a lot of that chatter has been going on and having discussions with board. So I think the M&A market is picking back up, but we're certainly not at the levels of the last 10 years or so. And the type of deals we've seen or we've been working on is more so merger of equals. And a merger of equal has that can be defined in many ways. I mean, people think of a merger of equals. It's really two institutions that are exact same size that are coming together. The board composition split. You sort of have co-CEOs. It's everything's split down the middle. And that is certainly an it's clearly an MOE, but really it's really a transaction. I view it as where there's not really an expectation of a premium from the seller's shareholder base perspective. In other words, the sellers are really investing, leveraging their investment in the current institution and reinvesting that into the combined institution is really what you're doing. And that's why it's really, it's saying, look, we don't need an initial premium, but we're looking at the upside potential of our institution on a combined basis. In deals that we've worked on during COVID, I'm sorry, I'm getting one head of my slide here. Yeah, so again, in terms of trends, as I said, I think your MOE, the type of deals you're going to see a lot more MOE transactions because, again, because of the bank stock prices and currency, so forth. I mean, the most important thing from an MOE, assuming you're comfortable from a pricing standpoint, is going to be the social issues. The board composition, the management structure, and the like. You really have to work that out, I think, really up front before you really sort of take a deep dive from legal counsel, investment bankers, advisors, et cetera. Because if you don't get that on sound footing, it's going to be very, very hard to get your deal done. I also think you're going to see an uptick in cash deals we talked about before because, again, selling shareholders, particularly, closely held institutions who are looking for a liquidity event, they're going to want pricing certainty that, frankly, bank stocks are just not going to offer, particularly in this environment. I think you're going to see well-capitalized banks, particularly credit unions, are going to be players. I know there was a big uptick in credit union acquisitions of banks. I think there was roughly about 20 in 2019. That's been down slightly this year because M&A has been down. But I know credit unions are certainly playing in this space, and I would expect that to continue. And I also think, and we've been working on a bunch what I'd call more measured transactions, where you have smaller institutions, making a strategic play to acquire branches to gain market share, or sort of look at, fee-based businesses, whether it's wealth management, insurance, employee benefits, and again, just to sort of diversify your bank's income stream. So you're not so reliant on interest rates, and you can get a steady source of income. And what a lot of banks have been finding, that's easier, if that is a goal of an institution, it's easier to do that vis-a-vis an acquisition than to try to do that organically. So this is what I'm jumping ahead to. Some of the lessons learned in the deals that we've gotten done during COVID, they've been getting done, and the regulatory process timing hasn't really changed. But certain areas, for example, due diligence. Obviously, due diligence in any transaction is paramount, but certainly, there's going to be greater emphasis with COVID on asset quality issues. And obviously, if you're looking at a target institution, what's the institution's exposure to high-risk industries that could be impacted by COVID, whether it's retail, hospitality, restaurants? Did the seller, adequately determine its allowance? How was COVID factor into that? Was that done correctly? Are there any liquidity issues with the target institutions? How impactful is PPP, in terms of, new customers and the like, and retaining customers? Then from a due diligence perspective, logistics. Just because, look at us right now. We're doing everything remote. And from conducting the days, on-site due diligence, frankly, is not happening. So making sure that you have access if you're acquirer, loan files and the like, and ability to conduct interviews or conversations with a person vis-a-vis remotely. So it is a bit challenging to conduct what I call the cultural due diligence. So again, this is something to sort of keep in mind. Again, it's been happening. It's just been a little bit more cumbersome than if, obviously we didn't have COVID to deal with. From a regulatory perspective, it's always a good idea, to have conversations with the regulators. just because regulators generally do not like to be surprised whether, you're a buyer or seller. You certainly, if you're a buyer perspective, you want to, any red flags from a regulatory perspective, you make sure you're addressing. And the one area the regulators are really going to be focused on is when you're looking at a target institution, sort of what are your pro forma capital levels going to be? And, just making sure due diligence was conducted very thoroughly. And you want to make sure that the metrics that you're using or your assumptions, really have credibility, and also you want to consider, stress testing, worst case scenario. For example, how you assess how accretive a deal is going to be to earnings. You may want to, and how that's going to impact your capital. You may want to look at, well, what if it's not as accretive as we thought? Are we still going to be sufficient from a capital perspective? That's sort of the things the regulators are going to be focused on. As far as M&A provisions, in our industry, I have to say, a lot of deal terms are sort of institutionalized, in a lot of non-bank transactions, particularly, if you're looking at the wealth management or insurance. There's a lot of deal structuring around contingent consideration, and that's not really the case in bank M&A. You're still seeing, fixed consideration. So what a lot of institutions have been doing or negotiating is we've been seeing more, for example, at closing, as a closing condition, that the target institution has a minimum equity level. And if they, again, and that's to protect if there's any asset quality issues or asset deterioration and so forth. Does the target bank have, sort of a requisite minimum equity level? And if they don't, what's going to happen, whether it's a walkaway right or, it's going to result in a price adjustment. So we've been certainly seeing more of that. Again, material adverse effect, I'm not going to spend a ton of time. It's a real legalese term. And really what that is, if you haven't been involved in an M&A transaction, this is a real heavily negotiated provision. And if there's generally, you buy a bank, you set up a deal, it's very, very hard to get out of it. And you have a provision where you can get out of it if there's a material adverse effect on the target institution. And so we've sort of been negotiating, whether or not or how impactful COVID would be on that definition. So that's sort of another big change just from an M&A provision standpoint. Then kind of going into measured acquisitions. You're seeing a lot of large institutions, for cost-cutting measures and realizing with COVID that, they can service, their customers and their employee base with less brick and mortar. And so they're closing branches or selling branches. And I have to say for smaller institutions that are looking to gain market share and maybe they can, beyond picking up some core deposits, they can pick up some loans. Branch acquisition is really could be a meaningful measured strategy and from a growth standpoint. And then I touched on this earlier. We've been seeing more of fee-based business acquisitions. I think COVID really brought to reality the importance of earnings and diversifying your earnings, because really your valuation is primarily going to be driven by your ability to get your earnings, your return on equity, and the institutions that can sort of be less reliant on margin and interest rate risk and have the ability to generate earnings from other sources are just frankly going to be more valuable. And so that's something to consider when you're thinking about from a growth standpoint, looking kind of beyond traditional bank M&A. And sort of then, and not to mention the fact, if you're doing, more wealth and insurance, you're sort of creating a one-stop shop and you can sort of cross-sell your products and so forth. So it's something to sort of keep in mind from a strategic standpoint. For branch acquisitions, a little bit different from a pricing perspective than, whole bank acquisitions. Generally, these deals are priced. You're paying the buyer is paying a deposit premium on the deposit liabilities that they're going to take from the seller, plus any book value of any tangible assets being received. If loans are included, that's going to be part of the pricing. And certainly, one of the big issues in these deals is certainly the real estate or the brick and mortar that you're going to be, whether you're going to buy the real estate or a lot of times it's just a lease and making sure that lease gets assigned to the buyer. That tends to, I would say create issues, but certainly a deal point. In terms of similarities to whole bank M&A, you're going to have a purchase agreement. There is a regulatory approval process from the buyer's perspective. And these P&A agreements, you're just going to, obviously besides pricing, I think equal importance is going to be just the logistics of the settlement of the payments. Because again, you're looking at that deposit liability that's coming over is going to be moving from when you sign it, from when you close, and just making sure that the appropriate the numbers and the deal metrics are captured at closing are important. You may want to have, I just did a branch deal. We had a minimum deposit balance at closing as sort of a condition to close from the selling institution, because again, just sort of avoids too much depositor runoff. And I think the other thing to keep in mind is attracting key branch employees. The branch managers, the tellers, a lot of the customers, that's a lot of times that's why they like banking with a particular bank more so than the bank business itself. And so just identifying who those folks are and maybe trying to figure out ways to keep them could really help just from keeping your deposits and avoiding substantial runoff. As far as fee-based businesses, if you're thinking about that, just sort of a high level, some things to consider. Unlike whole bank acquisitions where deal metrics are primarily, price to tangible book value, these deals are really looked at, it's really a multiple of the earnings of the fee-based businesses, or EBITDA, or earnings before interest, taxes, depreciation, et cetera. That's typically how these deals are priced. And then other factors into that is, working capital adjustments, on day one, how accretive the earnings stream is going to be, how your ability to gain market share. That could sort of adjust up or down sort of the multiple that's being used for pricing these deals. And then again, unlike bank deals, whole bank acquisitions, you see a lot of earnouts. And really what an earnout is, it's really it's a fancy word for contingent consideration. So a lot of times what these deals will happen is, let's say you're going to pay $1 million for a fee-based business. You might say, okay, we're going to pay $500,000 to the sellers at closing, and that $500,000 is going to be conditioned, but the remaining conditioned upon certain metrics being satisfied over a particular performance period after closing, whether it's 1 year, 2 years, 5 years, whatever that's negotiated. And really, the earnout serves dual purposes. It prevents a buyer from overpaying because you're getting benefit of what you paid for, and then it also provides a seller an opportunity to receive more consideration. So if there's any pricing gaps for fee-based businesses, earnout's really a good way to sort of close the gap on that. Other factors, due diligence is important. The biggest thing on diligence is probably obviously verifying financial metrics and the sustainable earnings. But I would say equally as important is assessing for these fee-based businesses who are the real rainmakers there at the selling institutions, and once you identify those folks, are they going to be employed, post closing, and so if so, you're going to want to have, for example, like an employment contract. And if they're not, you're going to want to have negotiated, a non-compete agreement. And it's a really good idea to have these sort of in place and executed concurrently with signing any purchase agreement. You certainly do not want to wait till closing to sort of address that issue. Structure, typically these are similar to branch deals, purchase and assumption transactions, not, where you're buying out the equity or mergers. And, P&A certainly, has certain tax advantages than whole bank acquisitions. As far as regulatory considerations, you start thinking about this, depending on if the fee-based business is going to be merged directly into, your institution and be sort of like a division of, versus, you have a separate, operating subsidiary of the holding company or your holding company or the bank, sort of has different regulatory approval pieces to that. So again, it's just something to keep in mind. If you're thinking how you're structuring it, what your goals are. Like, for example, if you form an operating sub, depending on the charter of your institution, you may need to give notice or approval from your banking regulator. So again, what I talked about before with just-in-time capital, if you're thinking about this, it may be worthwhile setting up an operating sub just so that you're ready to go if you find, a fee-based business that's worthwhile from a strategic standpoint.
All right. Going to launch the next polling question here. I can figure it out. All right, the poll has been launched. As a reminder, for the third time, please answer the polls if you are looking for CPE.
This one doesn't have a right or wrong answer. This question is, what is your institution's current capital situation?
Don't forget, if you have questions, please type them into the chat. We will get them answered. Jeff, I'm not sure if anyone has sent you questions directly. If so, I'm not able to see those.
I don't see any at the moment. But my email's on here too, and if anybody wants a copy of the presentation or questions, I'm generally always available.
Yeah. And we will also be sending the presentation to all participants at conclusion. I'm about to close the poll out. Oh, there we go.
It looks like institutions have sufficient capital. It's good. So we get to the last part of the presentation. I know we're coming up closer to 10 o'clock, and we have another poll question coming up too. From a defensive standpoint, I do a lot of, whether it's strategic planning, talk about capital, talk about M&A, even enterprise risk management. And as part of every presentation I do, I always really highlight to boards and senior management the importance of succession planning. And I think where institutions get a little bit short-sighted is succession planning. It's generally viewed as, limited to senior management who are next CEO, CFO, and obviously that has great importance. And certainly, you're going to want to think about, obviously from the board's perspective as well, who your next wave of directors are going to be. But I think in terms of if your goal is to remain independent, and you are, particularly if you're a closely held institution, you really want to think about shareholder succession planning. And that's sort of easier said than done because obviously they're the owners of the institution, and it's not necessarily the easiest. It's certainly a harder conversation to have than, let's say, the CEO succession planning, in my experience. But it really does have great importance, and it really needs to have a home, at the board when you're talking about various, because it's really impactful from a capital perspective, from an M&A perspective. And again, some of the things we talked about before, if you're a closely held institution, family owned, and your primary shareholder, let's say he or she passes away or passes on it starts, from a estate planning standpoint, what do those shareholders want? What are their goals with the institution? Are they sort of just like, hey, we love the stock, we love getting the dividend, we don't care about the market value? Some instances that's the case. Others are, maybe you're not paying a great dividend. It's like, well, listen, we want a liquidity event. There's no market for our stock. There's no ability to sell it. And that kind of that results in sales because, the easiest liquidity event is to sell your institution. So I think even if that's the end game or that's the plan down the road, I think some of the things we talked about before really, really impact, or the shareholder succession really impact, some of their capital raising strategies. Like, for example, maybe worthwhile having more liquidity in your stock, not so much to have a better currency to do deals, but to provide a liquidity event for your shareholders. Or if you do a modest offering, let's say you have a very large shareholder, we've done this, where you're selling shareholder sells stock as part of the deal. So you're not raising capital, you're just providing your certain shareholders a liquidity event, and you're sort of transferring ownership. And the other thing that we've been seeing as well as part of this is ESOPs. And ESOPs, for those of you who are not familiar with them, they are legally a tax-qualified retirement plan. So when you think about your 401k plan, which I'm sure most of your institutions have that, this plan would fall in that bucket. Well, really, with two big distinctions from a 401k plan. One, it's purely employer funded, and it's employer funded with employer stock primarily. It has to be for the rules. And two, and this is where the capital raising or the transactional piece comes into play, your ESOP, it's a separate entity, it's a trust, can actually borrow money from a third party or directly from your institution, your holding company, to finance or repurchase stock from a selling shareholder. So it can really be an effective tool, again, from a shareholder succession planning, because you can transfer ownership from, let's say, a large shareholder to your employee base. So shares are held in friendly hands. It's a retirement plan. But then again, it helps just from a independent standpoint. In addition to that, besides providing a liquidity event for shareholders, you could also use it to raise capital. And what you would just do there is the ESOP could borrow money and purchase stock from the holding company, and the holding company would just issue new shares to the plan. Now, the only thing with doing that is, again, that's going to be dilutive because you're adding new shares, but it is accretive from a capital perspective. And typically the way these transactions happen, because again, the ESOP trust is a separate entity, and the ESOP would borrow money from a third-party lender, and then that ESOP itself would then purchase the stock, whether it's from the selling shareholder directly or purchase stock from the holding company, newly shares, if it's going to be more capital raising. Now, the one thing to keep in mind where there's been a little bit of issue with this is that for shareholders that are selling, the price has to be based on an independent appraised value of the shares. So if the expectation is going to get a big time premium and the appraisal doesn't justify that, then the ESOP can't pay that. So we've had instances where that sort of did not lead to a shareholder purchase. So, but that all being said, it's sort of an outside the box, sort of strategy that some institutions we work with have incorporated. We have roughly about 80 community bank clients with ESOP. So it is prevalent in our industry, in terms of, for various reasons, strategic reasons and so forth. And then when the ESOP borrows money, the ESOP, again, it's a separate entity, has to pay back the loan. And the bank, what happens is every year the bank makes a contribution. Think of this contribution akin to like a profit sharing contribution to a 401k. The bank contributes enough money so that the ESOP itself can repay the loan on the shares, and the shares then within the plan get allocated to the participants pro rata based on their comp level and the amount of the loan is repaid. So that's generally how that works. So now it kind of leads to the whole question 4.
Jeff, has the ESOP activity slowed down, or are you still seeing the same frequency?
No, I mean, I think it's been steady, but I will say I think been having a lot more conversations with board just from the shareholder succession piece on that. I think it's getting a lot more. And part of it too is I think a lot of institutions frankly don't know that much about it. So even it's just from a learning standpoint, how it works, and how it could be utilized. It's always a good topic, from a general strategic planning standpoint. But
all right, thank you. Just a final reminder, if you haven't completed the poll, it is about to close. It is closed.
All right. I think, Mark, that concludes my presentation. So, as I said, thanks everyone. You know, it was a great pleasure to present to you, and really thank you to the Bonadio folks. It's always enjoy this conference, and as I said, hopefully next year we can do it in person and not virtually. But at the very least, I think hopefully this was worthwhile. And thanks again. And I'm sure you're going to enjoy the presentation from Piper Sandler. So take care, everyone. I don't know if anybody's got questions or anything. You know, as Mark said, if anybody, my email I think is on the front of the presentation. So if anybody has questions or needs any follow-up information, please feel free to shoot me an email or give me a call.
Thank you, Jeff. I do not see any additional questions in here right now, but thanks again for coming back this year.
I put the crowd to sleep. That's okay.
No, I checked. You can see the alertness, and there were only 2 or 3 sleeping.
All right, everyone.
Thanks, Jeff.
Thank you, everyone.
So as with all sessions, participants will receive a copy of Jeff's presentation and a webinar recording, along with a brief survey via email. Please keep on the lookout for those materials early next week. We welcome your feedback on the seminar series, and you can reach out to Jeff directly, as he said, or any of us with any follow-up questions, and we can route them accordingly. So with that, I'd like to introduce our next 2 speakers from Piper Sandler's Financial Services Investment Banking Group. We have Avi Barak, Managing Director, and Nathan Mittag, Director, with a presentation on strategic considerations for board members and senior management regarding recent bank performance, capital raising, and M&A. When we reached out to these guys, we let them know that the things that we're seeing. Obviously, they know the market better than anyone, but we thought these would be items that some that have entertained discussions on these items, and others that have thought about it but don't have enough information at this point. It'd be good information for senior management and the board. So with that, Avi and Nate, the floor is yours.
Hey, Mark, this is Avi. Can you hear me now? Awesome. That's a relief. I've been stressing about my lack of technology skills for about a week now, so glad you can hear me. Thank you, Mark, and thank you to Bonadio for the opportunity to chat with you today. As Mark mentioned, I'm Avi Barak. I'm delighted to be here with my colleague, Nate Mittag, who's also a director in our investment banking group. Just looking at the attendees on the webinar, it's wonderful to speak with many of you who we know from our time as Sandler O'Neill. And for those of you who we don't know, we look forward to meeting you in person in the very near future. Nate, if you have control of the slides, maybe I think you're on it's slide 43 in this materials. If it's okay, we'll spend 30 seconds on our firm, and then we'll dive into the materials. Until earlier this year, Nate and I, and how we know many of you, were part of a firm called Sandler O'Neill. Sandler was a 32-year-old investment bank and broker-dealer that worked with thousands of financial institutions across the United States, and primarily those were community banks. To a lesser extent, we work with insurance companies, asset managers, fintech companies, and other financial institutions. But over those 32 years, on a consistent basis, we were raising more subordinated debt for community banks than any other firm in the United States. We were doing more mergers for community banks than any other firm in the United States. We were raising more common equity for community banks than any other firm in the United States. We write research on more community banks than anyone else in the United States. We make markets for publicly traded banks, on and on and on. Earlier this year, Sandler O'Neill merged with another investment bank called Piper Jaffray, and we were renamed Piper Sandler. That merger actually closed on January 3rd. Obviously, we were targeting to try to close our merger literally the day the world was falling apart from COVID, but we weren't that precise. We just figured, we're working on all these mergers for community banks, so we ought to take a little bit of our own medicine, see what all these mergers are all about. Piper Jaffray was very, very well known, very strong in a lot of the same business lines that Sandler O'Neill was in, capital raising, mergers, market making, et cetera, but was very well known in healthcare, in energy, in technology, in consumer products, and were virtually non-existent in community banks, and they wanted to be existent in community banks, so they merged with us. So you can see that combination happened January 3rd, but Nate and I and everyone you probably know from Sandler are still here. We're still doing the same things, more of the same things, and now we just have all these extra business lines. So you can, on the next page, which will be page 44, these are the legacy Sandler O'Neill business lines. We are still doing all of them, and we'd love to be doing them with all of you. Though some of us we already are, and some of you we'd be delighted to do in the future. So with that background on Nate and I and our firm, we really wanted to cover three main topics today. First, we set a little bit of the backdrop, the current banking landscape, to give you a sense of where we are and why we think what's going to happen in 2021 is going to happen. Secondly, we'll talk about the current M&A or merger and acquisition environment and what we expect to happen in 2021. And then thirdly, we'll talk a little bit about the capital markets for banks currently and what we expect in 21. Jeff and Lou Scorman and our firm worked together on many, many projects. He did an outstanding job, excellent job, kind of setting that backdrop. So this will be a nice, I think, continuation of his discussion earlier. So with that, on page 45, again, it seems like an eternity ago, but you can see the violent and rapid change in interest rates to get us to where we are today. It was really, if you look at the left side of the page, it was only March 15th, which I think was a Sunday night, when the Fed cut interest rates to zero. I know all of us were very concerned about the health crisis and the health pandemic, but it's really remarkable to think that was, barely 9 months ago. And you can see that dramatic change in interest rates and the yield curve on the right side of the page, where we are right now in the orange. The bright side of that, of course, to the extent you can find one, is that we now actually have a positively shaped yield curve, which over time will benefit banks and depositories. On page 46, very, very busy slide. We apologize for that. You'll have some time on your own to kind of go through this in greater detail. But all this is really saying this is a recap of third quarter earnings for the banking community that Piper Sandler covers. So we write research, I think, on 400 community banks across the United States that are publicly traded. And as a general comment, 81% of the banks that reported exceeded the analyst expectations. 81% of banks reported better earnings per share than our analysts expected in the third quarter. That's remarkable. I've been doing this for 20 years. I've never seen that. What drove that? Two main things. One, the loan loss provisions, credit costs, were dramatically better, meaning lower. Provision expense was lower than expected for about 3/4 of the banks that we write research on. That was offset by dramatically worse net interest margins, meaning lower net interest margins. So when we blended those things together, our equity research department increased estimates for 78% of companies for 2020 and for 2021. And you can see that on that first line, earnings per share, as you go across the top of the page. So busy slide. We apologize for that. We'll get this cleaned up on the next iteration. But really remarkable third quarter earnings and, not quite the disaster scenario everybody expected. On page 47, and those if you printed it out, the page numbers are on the bottom right of the page. These are just the 5 main themes that we're seeing for the banks today. Obviously, number one, we just talked about credit has been so far significantly better. Asset quality has been significantly better than we expected. Secondly, there has just been a flood, a biblical flood to raise capital. As Jeff said earlier in his presentation, the vast majority of that is subordinated debt. To a much lesser extent, we are seeing some preferred equity being raised by primarily larger institutions. Virtually no banks raising common equity. So that rush to raise capital continues even through year end. Thirdly, obviously a quite challenging interest rate environment. The expectation is rates will be lower for longer, at least on the short end. That's been communicated by the Federal Reserve. We are seeing some relief on the longer end of the yield curve, with the 10-year now approaching 1%. Fourth, cost containment, cost control, controlling what you can, obviously critical importance at a time when there are macro factors that we can't control. And then lastly, the fifth main topic, all the regulatory changes, the election question marks, changes in consumer and banking law. I think a lot of that will be determined over the coming months. So you can just see that summarized at the bottom of the page. The tailwinds for the group, resumption of buybacks, credit holding in better than expected, and strong expense initiatives underway. The headwinds, obviously, we've discussed the uncertainty over the election and regulatory changes, excess liquidity, lack of loan growth, and margin pressure. Nate, am I missing anything or getting anything wrong? Are there any questions from any of the folks on the phone, or should we just keep going through?
From my perspective, you're doing great, Avi. I think one interesting theme that obviously stands out for a lot of community banks is the excess liquidity, which you mentioned sort of at the end there, and we'll get to a little bit later on.
We do have one question. The question is, do you believe banks have a good handle on the credit issues caused by COVID yet?
That is an outstanding question. I think as a general comment, I think most banks believe that they have their arms around their COVID-related credit issues to the extent that we have imperfect information, because nobody including health professionals, know how much longer this will go. I think in an optimistic scenario, and we actually have a slide on this, if the vaccine is successful, and between that and just general, the virus burning out, things start to reopen in the springtime, I think we'll be okay. I think if there's concerns about the vaccine's ineffectiveness, which does not appear to be the case, I think if there's lack of willingness for a high enough percentage of people to accept the vaccine, I mean, if the health crisis gets under control, I think, yes, banks have their credit issues ring-fenced. I think if there's another leg down, depending how far, how deep that leg down is, then unfortunately maybe the answer is not quite. I know that was a very generic non-answer, but that's my view.
Well, so my question from the accounting side, do you think the regulatory relief afforded by the CARES Act and the interagency guidance on loan deferrals, do you think there's any losses hidden in those that aren't properly reserved for, or do you think that the increase in COVID factors and we have obviously the CECL banks and the traditional incurred loss model banks, but do you think all of those potential losses are captured in the current provisioning?
I don't. My sense, and I'll let Nate feel free or anyone to disagree with me. My sense is it's not all. It's not all, but based on what I think is the most likely outcome to the health crisis, I think the majority is captured at this point.
To Mark, that's an awesome question. I think to put some numbers to it, Avi mentioned, and actually Jeff mentioned in his presentation all the subordinated debt we've been raising. So as a firm, we've raised subordinated debt for 85 or so different community banks, which means we've had to do essentially deep dive due diligence on 85 community banks before launching those capital raises. In general, the numbers have panned out similarly to what has been published in some recent articles, where those deferral numbers were like in the mid-teens to 20% of loan portfolios, and across the board right now, those deferral percentages are more like in the low single-digit percentages. I would think that because everybody's handling it a little bit differently, some of those deferrals were, we'll stop collecting principal for a while and we'll go interest only. Some were making more adjustments. So there's got to be some inherent uncertainty into what's going to happen with that group of loans. I will say on the reserve, a number of clients, if you're above 1% reserve, I think certain folks are trickling up their loan loss reserve ratio, but I think for a number of banks that maybe were in the 50, 60, 75 basis point loan loss reserve to loans ratio, those banks, at least in my client base in various geographies, are in pretty real time and as quickly as possible getting those loan loss reserve ratios up above 1%. And so I think that's a phenomenon that's occurred over the last couple of quarters where folks have just said, look, we aren't really seeing the losses yet in our portfolio, but we've got the right to take a kitchen sink approach, throw the kitchen sink at it this year while there's so much noise and uncertainty with the health situation. So I think in general, for smaller community banks that aren't already forced to increase their reserves due to CECL, which, I'll let you handle all those discussions, folks are still thinking around like that 1% number. They need to get above it. Just one, for insurance, and two, just to make sure that they don't have to deal with other issues from a regulatory perspective, if we do start to see more deterioration actually in real credit. Sorry if that was a little long-winded, but thought it would add value.
We'll keep going. So on the next slide, this is really just an interesting aside as it relates to cost containment and cost improvement across the banking industry. We Piper Sandler hosted a survey among senior bank executives. We actually hosted two surveys earlier this year, and it really focused on technology, digital transformation, cost containment. And as a general comment, it got a little, cut off on the top. But what were the biggest priorities from senior executives of banks of why or why not they were investing in technology as it related to cost containment and digital transformation? And the top two reasons, which were almost tied for what were the top priorities, were number one, cost reduction. And two was the ability to win new customers. And then third, with a little bit of a drop-off, was the ability to retain new customers. I don't think any of that will be a surprise, but it was interesting to see what were the priorities for our, the thousands of banks that we speak to on a regular basis. And then the top three reasons or impediments why those executives basically didn't do it were number one, and again, none of these should be surprises, it's just interesting, were existing architecture, meaning your core system, there's only a handful of them, and the level of complaints range. Apologies if any of those folks are on these calls. And two was obviously the cost of doing that, of changing, and the obvious unclear return on investment of doing that. But it was interesting to see what the priorities and what the impediments for not doing those things were as it relates to digital and technology improvements. So with that, we'll get to that's sort of we spent that piece as sort of the backdrop of where we were. I guess we have a poll question we have to do. Mark, Nate, you're the technology geniuses. I'm still trying to turn on the computer, so I'll let you guys do the poll question number one.
All right, I'm launching the polling question here. The poll has been launched. You should see it. As a reminder, for the fifth time today, if you would like CPE, please complete the polling questions.
So this, just as a general rule of thumb, we try to keep things simple for folks, and there, with our polling questions, there's no right answers and there's no wrong answers.
But if you answer B, Nate and I will be in your driveway tomorrow morning.
So yesterday we had Kevin from M&T, the technical accounting guy. And I got to be honest, his questions were very tricky. And as I answered them, I was wondering, can people see my responses? Will I be outed? All right, just waiting on a few more responses before closing the poll. We've generally had about 12 non-answers each time, so there might be 2 more of you out there that are looking for CPE. And there you are. All right, we're going to close the poll. Publish the results here. And the biggest concern looks to be potential credit losses, and a close second is low interest rates and increased competition. 4 of you have no concerns, or none of the above.
Very, very interesting. Mark, should we keep going?
Yes, I don't see any questions at this point. So
I would just on that point, if there are questions that come up while Nate and I are rambling, just ask them. This is a lot more fun if it's interactive versus us reading off of a page. So again,
and you can type those in. Sorry, all participants are muted, so they would have to type them in.
Awesome. So with that backdrop, we'll get a little bit into the second main topic we wanted to cover today, which was mergers and acquisitions or M&A. Not surprisingly, since the pandemic really took off, the number of transactions, the number of mergers in Bankland has been significantly slower. Certainly lots of conversations, but the number of announced deals is significantly lower. It's not non-existent, and we have a slide that shows that in a few, but significantly slower. There have been, and Jeff talked about this, and we agree with Jeff, a number of both high-profile and smaller mergers of equals, or as we call them, MOEs, and we do expect that to continue into 2021. But there have been virtually no high premium deals, meaning a bank selling for a significant premium to its earnings or its book value. That might return with the return to bank stock valuations, but it'll depend if that continues or not. We have a slide that'll explain that in a moment. Nate, do you want to just flip to the next slide?
Sure thing.
Or unless there's anything else you want to.
Nope, let's keep going.
So why do we think M&A will increase in 2021? So again, another busy slide. We apologize for that. But the thing I think you want to focus on here, there's 2 rows. There's the blue row, which is the optimistic economic case, or a V-shaped recovery, as some call it. And then there's this reddish burgundy row, which is the pessimistic case, which is a U or a W-shaped recovery. So as you go from the left side of the page to the right side of the page, which within those blue and burgundy rows, you can see that the potential for credit losses currently, and again, I think that's the biggest question based on the survey, and I think what Nate and I feel and how we feel as a firm, but credit losses seem to be coming in somewhat better than what we might have first expected earlier in the pandemic, meaning capital is building at our banks faster than we might have expected. That said, so the optimistic case from a credit perspective. But as you go to the right side of the page, organic growth opportunities, meaning loan growth, not acquisitions, appears to be more pessimistic. For many, many banks, not all banks, loan growth outside of mortgage especially has been much slower than expected. And that is, again, building capital. So we're building capital faster than expected because of less and fewer credit losses. And we're also building capital because we can't deploy and leverage our capital into more loan growth. So if we're building more capital, what are things that we can do with that? We can announce or implement a dividend. We can increase our dividend if we already have one. We can repurchase shares, especially if our stock is trading at a discount to book. What if we've already done all those things? We'll look to do mergers. We'll look to deploy that capital into acquisitions. That is one of the main drivers we think M&A will accelerate in 2021. The optimistic case for credit and the pessimistic case for loan growth and the building of capital. Nate, anything you want to?
No, I think from a strategic standpoint, this I think has to be thought about for banks that are public. In particular, is just simply the analysis of one versus the other. A lot of public banks, particularly when their stocks were trading below tangible book value, and for a long period of time this year, the majority of public banks were trading below tangible book value. Obviously, a share repurchase becomes very attractive at that point because stock is so cheap. As stock prices, and they have since in the last quarter or so increased, the economics of a share buyback become less attractive. So if that becomes less attractive and you're trying to find a place to deploy excess capital, because public banks can sometimes be hurt from a stock price perspective if they have too much excess capital, and they have to find a place to deploy, and then obviously M&A becomes the most obvious option, I would say. So then you can at least compare one versus the other and come up with what you think are proper economics to choose one over the other. Private banks themselves, though, particularly in my client base, have been talking about share buybacks themselves for the last couple of years as well. They've just been doing it from a different strategy. They do it over their desk. Shareholders call them. So it really comes down to what your shareholders are looking for from a long-term investment horizon.
Page 52 is really a summary of everything we've been discussing for why we think M&A will return in 2021. Again, just going across the page, I don't know if there's any questions, Mark, but obviously the virus and the health pandemic, overcapacity in the banking system, uncertain economic backdrop, challenging interest rate environment, excess capital, which we just touched on, improved stock market receptivity, meaning public banks that have announced acquisitions have actually traded up. Their stock price has gone up. That is not necessarily always the case. Sometimes the market will say, well, you overpaid, or we thought you yourself would sell your bank, so the stock price goes down. Improved buyer currency, which Nate just talked about, and financial and technological disintermediation, which we've discussed. Any questions on that slide? I think we can keep going. Again, mergers of equals, or MOEs as we call them, the advantages of doing them on the left side of the page, the challenges on the right side. I think most of these are, the folks that use Bonadio are knowledgeable folks, and none of this should really be a surprise to them. The advantages, obviously you're finding key roles for most of the executives and directors of both companies. You keep all your current client relationships. You can improve liquidity given the larger shareholder base. Financial metrics are also normally very, very compelling. And the disadvantages is, frankly, they're damn hard. They're damn hard to get done. They're very, very challenging to get done. But if you can get them done, often very, very compelling. And we are seeing a lot of them currently. We can jump to the next page, unless Nate, if there's anything you wanted to fill in, or if there's any questions.
We can keep going.
This week, we, as promised, the left side of the page just shows the number of mergers over the last 10 years per year. I think we exclude some very, very small mergers. I think it might be a $15 million merger cutoff. But you can see in 2010, there were, 49, then 53 and 11, 77, and an increase over time. And then in 2020, obviously a massive drop-off. I think there's been 33 mergers, excluding very, very small mergers. Again, not surprising, but just to give you an order of magnitude and an order of, the directionally what a significant drop-off. And on the right side of the page, you can see by month, right? January, February, March, really we didn't have the pandemic to deal with yet. You saw 11 mergers announced in January, 5 in each of February and March, 0 in April, 0 in May, 1 in June, 1 in July, and then a little bit of an uptick in the later months. There'll be a few in December, and again, we expect this to continue. But just to give you a sense of how dramatically the drop-off has been, it's pretty eye-opening, I think.
One thing that stands out to me, Avi, on this page, if you look at the monthlies on the right-hand side, and you compare that to that 18%, which is on the line graph on the chart on the left. So we're saying 18% of deals of size that have publicly announced their deal values are above $350 million. So I guess what we're calling that are strategic transactions, large size transactions. On the right side, though, since the pandemic, where you can see in April and May, there were 0 deals announced. 25% of all deals announced nationwide were greater than $350 million, and those are the 3 highlighted. So that 18% on the chart on the left for 2020 year to date is actually 25% plus since the health situation started. So it's even more amplified. I think, we were talking about mergers of equals being a hot topic last year, even before the health situation. But I think given the acceleration in so many different things from technology and expense management and things of that nature that have been spurred on by the pandemic is the reason why some of these mergers of equals, particularly with companies that have historically known each other and maybe they have relationships at the senior levels through the board levels, those deals are happening. Even though they can't go on site and do diligence, these companies have the ability to go in virtual data rooms and diligence each other remotely and just do conference and Zoom calls and be able to get a good deal done. And interestingly enough, like Avi mentioned before, the stock market has reacted well to I would say almost all of these transactions, that have been announced and are well known because of their size.
On page 55, it's sort of an internal Piper Sandler joke that this is one of my favorite slides, and it's mandatory to include in every presentation. But it's really a remarkable slide. If you look at this just shows it goes back to 2010 on the left side of the page, forward through to 2020 on the right side of the page. Very, very simple, but very profound, I think. The yellow squiggly line at the top, what is that? That is the price to earnings of mergers that have been announced. So you can see it's kind of, 19.7 times earnings in 2010. It's kind of gone generally in that area, and then it's obviously come down primarily because bank earnings have gone up with tax reform. The middle dark blue line, that is the price to tangible book. So if you have $100 million in equity and you get $200 million for the bank, you're getting 2 times book. I think most people on this call understand that, and that's been pretty. Again, it's creeped up a little bit in 2018, and it's obviously come down in 19 and 20. To me, the most fascinating thing on this slide and why it's so interesting is the bottom light blue line. What is that? That is the deal value compared to where the buyer's stock price traded if they were a public company. What does that mean? That means if I am a buyer and I trade at 2 times book, I can pay you 2 times book for your bank. If I trade at 1.5 times book, I can pay you 1.5 times book. If I trade at 1 times book, I can only pay you 1 times book. That number, that percentage has been remarkably consistent, irrespective of health crises, credit crises, election crises. It's generally around 1 time, 100%. So we always get asked when Nate and I run around the country or Zoom around the country or FaceTime around the country, what is my bank worth in a merger? And the real answer to that is, well, where does the buyer stock trade? Because if the buyer trades at 2 times book and he's willing to, or she's willing to, she can pay you or he can pay you 2 times book. If they trade at 1 times book, they might love you and your banks have known each other for 100 years, but they can't pay you 2 times book. If they trade at 3 times book, they can pay you 3 times book. There's a difference between willingness and capacity, but that's remarkable that over time that line doesn't really move. And that's really profound to me at least, but maybe I have a warped way of looking at the world. Nate, Mark, any you can correct me if I get it wrong, but that's I find this really fascinating slide, and it doesn't change.
Well, so it is fascinating. What's interesting to me on this line too is if you look at 2017 and just go to the top where you see that yellow EPS is 21.4 times earnings was the average price to earnings multiple for all deals in 2017. Why does that number drop in 2018, but the price to tangible book value multiple goes up? I think the answer is tax reform was put in place, and so bank earnings in general were going up, earnings per share were going up. That's the denominator in the yellow line calculation. And banks themselves, because their EPSs were going up, were becoming more valuable, and just the banking sector in general was a more value proposition for even generalist investors at the time that were buying into the space because they knew banks would be very positively impacted by tax reform. So that's why those numbers are moving in that direction. And you can see that from 17 to 19, this is obviously regardless of your politics at the presidential level, but it was a good time for bank sellers to get premium valuation, probably the best time since the credit crisis in 08, 09, and 2010. The phenomenon in the blue line at the bottom that Avi was talking about shows in both kind of New York deals that have happened in the last year that we have case studies for in this presentation, and so we'll get to that in the next page or two. But it was similar for when the Bank of Akron sold in Buffalo, and that was a premium deal with like a 30 to 40% premium on the stock, and it was exactly the same math that Bridge and Dime did for their merger of equals that was announced earlier in the year. So even though one's called a merger of equals and one's called essentially a sale takeout, the math was essentially the same from the buyer's perspective, and that's represented in that bottom blue line. I think we're on to a polling question now, Mark.
Right. Wait a minute. All right, the poll has been launched. So how much, with the time it takes to close, how often is it really just a timing factor where, you've locked in and obviously the price can be based on, if it's stock or cash, but that could change the ebbs and flows there. I don't know if my question makes sense because I can't even articulate it properly, but Nate, I can't hear you.
Can you hear me?
Yep.
Well, I'll just bring the example up of the Bank of Akron sale to Clearfield National Bank out of Pennsylvania, which folks in New York would probably know it as Bank on Buffalo is their trade name in the Buffalo market. That deal was announced in December of 2019, and the valuation of the company was over 170% of tangible book value. For those that know, the Bank of Akron was owned by the Forrestal family, very well-run bank, Very, very kind of plain vanilla bank that they've owned since the Great Depression. We had a lot of buyer interest in that company, and that's public information because of S4 filings. So by them having an option and choosing to merge with CMB Bank on Buffalo, at the time, like I said, that deal was worth over 170% of tangible book value. And I think a quarter to 30% of that deal was paid in cash. The rest, the majority of it was in stock. And so the deal did not close by the time that the health crisis started in March. And so with the rest of the sector, CMB's stock declined significantly to a point where the deal essentially was worth, instead of 170 of tangible book, it was worth about 120 to 130% of tangible book around the time it closed. So if you're a shareholder, you're a little disappointed in the fact that the stock is worth significantly less. But the question is, are you better off by being part of a bigger institution that has more flexibility and more access to capital, et cetera, to kind of weather the storm? One smart thing that the Bank of Akron board did was they wanted some cash in the deal. So that 30% plus in cash that they got was a fixed price. So, if there's a lesson to be learned from these types of environments, it's that cash is always good. It gives you certainty, and if you're selling your company and there's the ability to take cash, that's going to take pricing risk and frankly economic risk off the table. It could limit your upside, right? Because if you think you're buying into a stock, the buyer's currency that we've been talking about as a recurring theme here for the last couple presentations, as a seller, you're buying into that new company if you're taking stock. And so, cash gives you certainty, but it also limits your upside. It's the key question for all boards that are thinking about their strategic alternatives, Mark. So it's a good question, especially in uncertain times.
Well, and my follow-up to that would just be, in that scenario you presented, what would the value be now based on the recovery since they closed? And is there a holding period or just for certain individuals?
So right now that deal is in between its low point when the health situation was at its worst, and from when the deal announced, it's somewhere in between. The exact math is probably around 150 of tangible book, give or take. But that deal is now closed, so there was never any issues from the shareholders' perspective. They still voted for the deal. So I'd say that the deal has recovered. In between all of this, CMB has also gone out and raised some capital. So they've actually been able to kind of do the things that I think from the Bank of Akron legacy perspective would have been harder to do, to the extent if potentially there were any credit losses or anything like that at their size. It's obviously a little harder to tap capital markets in a tough environment. I mean, we've shown that small banks can raise capital today just because we've done so many sub-debt deals for banks, less than 500 million assets, which we have on a later page. So I think you still have options, but they've clearly got an easier path by being part of Bank on Buffalo. Avi, did I miss anything here?
No, I was just, you left out the most important part, which of course was the fact that the deal value went down between announcement and closing, meant that Piper Sandler and Nate and Avi's fee on the merger went down also, because our fee is based on the merger consideration, which is obviously, despite what some people think, we are a for-profit institution. So that was devastating. But just felt like that was important to know.
They got a good deal. They got a good deal, and they all elected to go with it. I think what ends up happening in that type of deal is that they get to I know we have some time here, so I want to dig in on this question. But they were able to make an election on whether or not each investor was able to make an election on whether or not they wanted cash or stock. Now that can be different for every deal depending on how you want to negotiate the process to closing of the deal, but in their case, they were able to elect. And obviously when the stock decreases like that from the buyer's perspective, for the buyer stock price, then the value of those shares that the selling shareholders are taking is less. So as many as they could voted for cash, but there were mechanisms in place that net the deal was still going to be this percentage in stock and this percentage in cash all in. So that was actually kind of what your question was leading to, Mark, too, is most of the shareholders, I think from the board's perspective, would be in it, I think for the long term. So if you were getting stock, you would just hold on to it and allow it to recover, particularly given where stocks are trading. But every investor's got their own plan to make their decisions on.
Yep.
Are we okay on the polling?
Yeah. Did I not close it? Yeah. Oh, is there another one I need to launch? Sorry.
Yep.
Try that one. Sorry about that.
That's all right. I think we're fine.
Nate, do you want to go to, or do we want to do this poll question also?
It's running right now for those of you looking for CPE.
Just while we're doing the poll, and then we can discuss the poll. Does that work?
Yeah, let's keep going.
So we have just a handful of more slides on mergers and acquisitions, or M&A. This is just a listing, and you can review it on your own time, of the mergers, the bank mergers that have been announced in New York State since 2016. They are sorted chronologically from most recent at the top all the way back to March of 16 down at the bottom. The shading just means it's a transaction where Piper Sandler either advised the buyer or we advise the seller. And you can just see the deal metrics on the sort of middle part of the page, and the information about the target, about the seller on the right side of the page. And then in the blue at the bottom, you can see the averages and the medians. Nate, did you want to talk about some of the deals on here, or should we just keep going?
This is the busiest slide in our presentation. It's an eye chart for those of us that are blind and wear glasses or contacts. But the dates of the announced dates are in the fifth column. And so what was interesting was 2019. There were 8 transactions announced in New York. Many of them upstate New York. A few of them kind of in and around the city. And so 8 deals stood out because the previous year of 18, there were 4 transactions in all of New York. And the year before that, there were only 2. So M&A, I think, was picking up in New York State for a variety of reasons. And then obviously slowed down in 2020. But of the 4 deals that were announced in 2020, 2 of them are mergers of equals. So folks do have opinions on MOEs. Are they real? Are they really mergers of equals and things like that? But those deals are happening as we speak, and there's going to be more announced, I think, in the coming months.
The last 2 slides in the M&A. I'm sorry, we have a case study on Bridge and Dime and Bank of Akron and TCB. Nate, do you want to just spend 30 seconds on each of those? We've got about 15 minutes left to get through this, and then the capital section.
The 30 seconds on this, and we're on the Bridge Dime MOE case study announced earlier this year. On the bottom left are the transaction metrics. And so the price to tangible book value of this deal was 97% of tangible book value. So that's I think a relatively cheap price compared to other mergers over the last few years. But Bridge, who run by Kevin O'Connor, is one of the best management teams in the United States. At the time, I think they were only trading about 1/10 of tangible book. So that 1/10 versus the 97% paid is that percentage blue line that Avi said was his favorite, graph of our pages a few pages earlier. And it's very similar math to the Bank of Akron, which was obviously a much smaller deal, only $65 million. but their price to tangible book value on the chart on the bottom left, right in the middle, was 171%. And CNB, the buyer, which their ticker here is CCNE, they were trading 190% of tangible. So that incremental difference there is the math that we were talking about on that graph a few pages earlier. And it's very similar on a percentage basis, relatively speaking, in both deals, even though one was a merger of equals that was almost $500 million in deal value, and one was an actual sale and only $65 million.
The last two slides in the M&A section are just a little bit of a commercial for Piper Sandler. We obviously do a lot more mergers for banks than any other firm in the United States. This is just the last 5 years. We've done 314 mergers compared to second place at just over 200. And the same is the case of deal value. So number of deals and deal value. And then lastly, on guess it's page 61, we occasionally, again, when Nate and I and our colleagues are running around the country, some of our competitors in the merger business say that, well, we don't care. Piper Sandler doesn't care about small banks. And then some other competitors say we don't care about large banks, and other competitors say we don't care about mid-sized banks. And of course, all of that is complete hogwash and nonsense. So what you're looking at here is going back to 2013, the mergers that we've announced based on the asset size of the company. So as you can see, consistently over time, we work with many, many small banks, many, many medium-sized banks, and many, many large banks. So we love all kinds of banks, irrespective of size, geography, and business model. So if you hear that, you can direct them to Nate or I or this page.
Question while you have this page up. How many of these 19 transactions that you've closed in 2020 were in the pipeline pre-COVID? All of them?
That is an excellent question. I would say probably the vast majority.
How many fell out of the pipeline?
I don't think any have fallen out of the pipeline. I just think that they've hit the pause button. I mean, that was with Bridge and Dye. I mean, they've been talking forever. I worked on 2 in Virginia this year. It was amazing. One of them, it was Virginia National and the Fauquier Bank in Northern Virginia and Charlottesville. Those banks have been talking literally for decades. And it just took a pandemic to get them together. Another merger of equals we announced was in Virginia. It was Blue Ridge and Bay Bank of Virginia. Bay Bank of Virginia had really started a process pre-COVID. Blue Ridge bid on it, and then they hit pause because the bid date, ironically, they were much more precise than Piper and Sandler O'Neill. The bid date was actually the day the NBA suspended, so they obviously had to hit pause on their merger. But then they rekindled and announced a transaction at the beginning of the summer. So I think
where do you see this number going in 2021? Realistic, not lofty goal.
Realistic number of deals?
Yeah.
In a normal environment, between 3 and 5% of banks merge every year. That number is a lot lower this year for obvious reasons. I think if we go back to 3 to 5%, 3 to 5% of 5,000 banks, right, was that 250 banks? You're the accountant. Yep. So, if there's 250 banks, we like to say we'll get half of them. So we'll do 100, 150 mergers next year. Maybe that's a little aggressive.
That's the industry. So, I mean, I would see us, if your question, Mark, was about us, I'd say us, being in the range of kind of where that 16, 17 marks are in the middle of the page.
Gotcha.
And you can see, go ahead.
I guess my next question is from the slide you had earlier. Why would I want to sell my bank right now? And it seems to be a buyer's market if you see, upside. But the buyer needs to obviously find a willing seller. So those that have been thinking about it and are not in the pipeline yet, what reason would there be to go to market now?
It's a great question, and if it's all right, Nate, I'll take a quick shot at it, and then please amplify or correct whatever I got wrong. But just to be clear, we don't go to a bank and say you should sell your bank, right? if an investment bank, all they do is sell banks and they're calling on you, there's a reason they're calling on you. They either want you to sell your bank or they want you to buy a bank. If all they do is raise capital and they're calling you, they want you to raise capital. If all they do is, buy and sell bonds or loans, there's a reason why they're calling on you. We do all those things. So we don't, it's almost liberating for guys like me and Nate. We don't really, our job is to solve the pain point, the pressure point that you have. So why would a bank sell today? Well, there's a lot of reasons. They might say, I was thinking about selling before COVID because I didn't want to go through another crisis. Now we're in one, but I think it's stabilized. And it's too much work. I'm 70. I thought I'd be retired by now. I definitely don't want to be doing this when I'm 80. I've got a place in Florida. I want to find a partner that I like. I like their culture. I like their stock currency. They're going to take care of my people. They're going to take care of my community. Maybe they'll let me keep my name. And they're going to give me stock so I don't have to pay a big tax bill. So if I take stock from a buyer who's trading at 1 times book, who's going to trade to 2 or 3 times book, that's pretty compelling if you don't want to do this. If a guy's trading at 2 times book now, his stock might trade down to 1 times book. So you might not want to do that. So there's lots of reasons why a bank might merge. It might be, they might say, I have to eliminate a lot of costs from my infrastructure, but I also have to walk around town and not get eggs thrown at me. But if I announce a merger, maybe there's a way to do that in a more elegant way than just, firing half my people and shutting half my branches. So there's a lot of different reasons, but you don't have to sell your bank. You might say now's not the right time. Maybe my economics based on my capital, my loan growth, my profitability, market share gains from other mergers that have happened pre-COVID are too compelling.
Yeah, I would think at this point, especially for the banks that have been around hundreds of years or since the Great Depression, like the one you talked about, they would want to build up and get back to that level before they entertain that idea, whether succession planning or something else. And I think the remainder of your presentation kind of talks about that.
So we can Jeff and Luce talked a little bit about this, so we don't need to rehash. 63 is just sort of the backdrop of the subordinated debt market. January pre-COVID, February, March, when there was a lot of market dislocation, and then since then, Nate, you can flip to the next slide, I think. This slide just shows the dark line is the 10-year Treasury, which everybody on this call will know, and the blue line is just credit spreads. In plain English, it just means what does a buyer or an investor demand in coupon over the risk-free rate or the Treasury rate. And you can see that, just a blowout in April, and then we've really come back to where we were prior to the pandemic, and at lower rates, which is why there's no spread anywhere. The next slide, this is a little bit of our secret sauce, which isn't so much a secret, it's just hard to replicate. Again, Jeff mentioned this, and it is true. We do more subordinated debt than any other firm by quite a large margin. The top shows who are the buyers. So round numbers is about a third banks, a third insurance companies, and a third money managers, so mutual funds and the like. And then the bottom just shows a couple of recent deals that we did. It's not public information, so we left off the names, but the ultimate allocations for the buyers for a number of recent deals, you can see kind of range between, roughly half banks to 100% banks. And you can see the mix between money managers and insurance companies. We'll keep going in the interest of time. Very, very busy slide here. It just shows, going back to January of 2018, what are all these dots and shapes and colors? So just to orient you on the page, and then you can look at this on your own time. The black squares are banks that issued sub-debt that are smaller than $1 billion in assets. The blue diamond or rhombuses are banks that issued sub-debt that are between $1 billion and $2 billion in assets. The yellow triangles are 2 to 10 billion in assets, banks that issued sub-debt, and the orange circles, man, this is like a colorblind test, are banks that are greater than 10 billion in assets. So you can see really since May of 2020, there's lots and lots of black squares, blue diamonds, yellow triangles, and orange circles all clobbered on top of each other. What does that mean? There is no intermediation or disintermediation between banks of size. They're all able to issue sub-debt roughly between 3.5 and call it, 6 1/8. You would think that banks that are larger should be issuing farther down the page. So there should be more orange circles at the bottom of the page and more black squares at the top of the page, but they're all on top of each other. So said another way, it's a great time to issue sub-debt, irrespective of size, but especially if you're a small bank and the market is open and receptive to that. Nate, anything you want to say there? So we'll just keep going, I think, given that we have 3 minutes. Another seeing eye test. These are a listing of all the sub-debt issuances that have happened in New York State. They're sorted chronologically from most recent up top to further back in time down at the bottom. The gray or blue means it's a deal we worked on. And just to give you, to orient you on the page, and then you can, again, review it on your own time. A bank that most of the people on this webinar will know, it's the fifth line, FISI, 5-star financial institutions. As you go from the left side of the page to the right, their ticker, 10/7/20, October 7/20, they issued $35 million to Piper Sandler. It was HC sub, meaning holding company sub debt. You can see the coupon there, 4 3/8. It's fixed at that rate for 5 years. It then flips to a floater. They are able to call it. Most banks are able to call after 5 years. You can see their rating, which was BBB from Kroll, and then just a spread to Treasury. So you can review these at your own time. Lots of interesting data points here. Nate, I think we can keep going.
Yeah, these are the last couple of pages.
Yeah, we included two case studies. Again, both banks that most people on this call will know. The first is for Evans, which we raised $20 million for. The second is for Orange County Bank and Trust, which is really remarkable. They're very similar banks as far as size goes, but really the collapse in yield, the collapse in coupon between July and September. Evans, if they came today, would probably be at the same coupon that Orange came at, but they issued at 6%, whereas Orange issued at 4 1/4. Again, you can see the transaction highlights how many people were contacted, how many people gave us orders, what the mix was between banks, insurance companies, and money managers. But I think the takeaway here is the market for sub-debt for regional and community banks is as hot as it's been in history. There's no bank too small, no bank too large. That will not last forever, but it's lasting right now, and we expect it to continue for the foreseeable future. And lastly, another little commercial for Nate, Navi, and Piper Sandler. We do more of this than really all of our competitors combined, and that's been the case since the market really reopened in 2013 and 14. And I think the last two slides are just two pictures of really, really good-looking guys and their biography and kind of the stuff that they've done. But
you look great, Avi. You look great.
I tried to look serious, but not too angry.
I'm going to launch the final poll while Avi launches his 8th commercial of the forum. For those of you looking for CPE, please do not forget to answer this final poll. I believe you need to have answered at least 75% of them to receive full credit. Do we have any other questions? In the meantime, I do not see any.
Did they all hang up or disconnect?
No, we've only had about 3 or 4 drop off.
Those were when Nate was talking.
Yeah, it might have been. Do you guys have anything else you wanted to discuss? I mean, I guess I had one more question, and sorry if you mentioned it, but how is the interest rate generally determined for the sub-debt offerings?
It's an excellent question, and it's an industry standard. So the fixed portion, most of these are 10-year final, not callable by the issuer for 5 years. And if they're not called by the issuer, they then flip to a floating rate. The fixed rate is literally supply and demand. So if there's a lot of demand, it will drive it lower. If there's not a lot of demand, it'll be higher. So that 6% for Evans was just based on supply and demand. That 4.25% for Orange was supply and demand. The floating coupon is set by industry standard. It's not something that Sandler or Piper Sandler or the other people in that business invented. It's literally it's a spread to. It used to be 3 months LIBOR. It'll now be 3 months SOFR. It's a spread set at the time of issuance to SOFR. It's the fixed rate minus wherever the 5-year swap rate is the day we price. So I think the 5-year swap rate, I don't have Bloomberg open right now, is, 20 basis points, let's just call it. So that coupon would be, if you were at 5% fixed rate, it's 3 months SOFR plus 5% minus 20 basis points, 4.8%. And they would just move. So if obviously SOFR went up dramatically and you were the same size bank with the same credit profile, you'd call it. And if SOFR doesn't move 5 years from now, you just let it float. What most banks that do over 5 years, they're larger, or they're more profitable, or they've been acquired, or they might be able to get a rating. Jeff mentioned this in his presentation. If you got a rating, it can drive the coupon lower. So you might issue new sub-debt at a significantly lower fixed rate and call the outstanding issue. I hope that answered your question.
Yeah, no, very helpful. I could probably ask you 50 more questions. Oh, we do have one additional question before we wrap up. I know we're a little over our time here, but what's the negotiation process like? I.e., how is that final rate determined? Do investors and issuers both use Piper?
So we would be what's called the underwriter or the investment banker for the issuer. So the issuer would hire us, and he would say, we want to raise $10 million of sub-debt. And we would say, okay, you're a $500 million bank. Based on everything we know about the markets, that coupon is going to be, call it 4.5%. And they're going to say, okay, you're hired to go raise us $10 million of subordinated debt. Please get us the best rate possible. Our fee is based on how much they raise. So we would go out to our bank network, our insurance company network, our mutual fund network, and we say, hey, we have a bank, and usually these are done as private placements, so it's not a public, no one knows about it until the deal closes. And we would try to raise $10 million. And if we got $50 million of interest at 4.5% for a $10 million deal, we would go back to the issuer and say, well, do you want to raise 15 or 20? And they're going to say, no, we want to just do 10. So then we start saying, okay, buyers, however many there are you in at 4.25? And half of them might drop. But we're still at 25 million. And then we might say, are you in at 4%? And then another half might drop. And then we might say, well, it's 375. And now we have $10 million at 375. So it's literally, as Adam Smith said, the invisible hand. How much can we get for the issuer as low a coupon as possible? Now, the alternate might be true. We might say, nobody cares at 4.5. We think your $500 million bank is a great bank, but you ain't getting 4.5. I'm in the deal at 5. And now the issuer might say, well, I'm not issuing at 5. So it literally goes, it's that simple, and it's really a transparent process.
Okay, and we did receive one other question. How do you address the issue of independence if you are acting for both buyer and seller? So this would be on the M&A side.
It's a great question. You can't be on both sides. So either we are representing the seller or we are representing the buyer. What has happened over time is that we have found, and if you talk to the guys, the Forrestalls at Bank of Akron, or, Mike Horodisky over at Wallkill, or, the hundreds and hundreds of clients and thousands of clients we work on for balance sheet work or capital raising, is that we just tell people the truth. And over time they find that, that they trust us. And if we're representing the seller, we're giving them good information. If we're representing the buyer, we're giving them the best information we can to have them submit an appropriate bid. So the short answer is we don't. If we're representing the seller, we're going to try to get them the highest price, if that's what they want, within the framework of the box that they give us, and just give them good advice. If we're representing a buyer, we'll say, look, we know what's important to these people. You need to take care of their executives within giving them a good price. You need to have them keep the name. You need to have, you need to keep all their people. So if you give people good advice and you tell the truth over time, generally you're going to get hired more often than not. Nate will have the more technical answer, but that's the real answer. That's the real answer. Nate, go ahead. I'm sure I left something out.
Good. You're rolling.
All right, guys. Thank you both, Avi and Nate, for your time today. We apologize, everyone, for going over a little bit, and only 10 of you dropped off. Thank you again for attending our seminar this morning and yesterday. We hope that you found these sessions informative. As mentioned earlier, you will receive the presentation materials and the brief survey next week. And if you have any questions, feel free to reach out directly to our presenters or to any of us at the Bonadillo Group. And we hope you enjoyed the content today. I know I did. And thank you all for being here. Have a great day.